Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway. Brought to you by Paramount Residential Mortgage Group.
Welcome to another edition of Master of the Markets. I'm Barry Habib, and MBS Highway is created exclusively for NMP TV, and it's brought to you by our good friends at PRMG who are working for your best interest. Hey, we got the big jobs report last week, and it was interesting because the number came in a little lower than expectations. That's kind of bond-friendly, but not very much lower, and it was still a pretty strong number, almost 560,000 new job creations. That's pretty big. But then a couple of other things that would normally hurt the bond market. One was the unemployment rate dropped from 6.1% to 5.8%. Hey, bond market should be a little bit concerned about that. But the real one the bond market should be concerned with was the level of increases in wages, which that creates a fear of wage pressure inflation. And inflation, well, that's the arch enemy of the bond market. And, we saw those numbers come in pretty big. Hourly earnings up 0.5% for the month. And on weekly earnings, also 0.5%. That's a much more important number to look at. When you take this and you combine it with the previous number for weekly earnings of last month's increase month over month, that was 1%. That means it's up 1.5% in just 2 months. Hey, look, if you take the last 3 months and say that this was kind of a period where we started to see some reopenings, and you extrapolate that over the course of the year, it's a 7.5% year-over-year gain in wages. That's pretty hot for the bond market. So why did the bond market like these numbers? Well, it's because of some Fed speak. And how out of touch is the Fed really? Now, the second in command, we know Jay Powell's the chair, but the second in command is the New York Fed president, John Williams. And he said that we're far away from seeing improvement. Really, Mr. Williams? We don't have pretty good job growth here. We don't have big numbers that we got last week from ADP and job growth, 1 million jobs created in a single month. We don't see inflation heating up a little bit. I guess he wants to ignore that and says we're going to keep on keeping on buying mortgage-backed securities and treasuries, which they're doing with both hands. They're doing more than they're telling us they're doing. And the bond market certainly did like that. Now, it's interesting because the Fed is truly out of touch with this because they're going under the cover that we're going to keep on doing this until we see the unemployment numbers get back to those low levels before the pandemic, which, by the way, is kind of an anomaly to see them that low before the pandemic levels. But either way, think about why we are seeing these higher levels of unemployment. Now, it's improved, certainly, but there's still almost 8 million job openings. Why aren't they being filled by the almost 8 million people still out there, or as actually receiving some sort of benefits? There's 15 million people still receiving some sort of benefits. There's 2 reasons. One is, let's face it, getting paid $17 or $18 an hour to stay home, you can't blame people for not wanting to go and fill those jobs because some of those jobs might be difficult jobs that they don't really like. So there's an incentive to stay home. But that's not everybody. There are some people that really are struggling that want to work, even if they're getting paid to stay home, but because they have children and schools aren't fully open or daycares aren't fully open, it definitely creates a barrier. So while we understand why at the present time we aren't out there filling these positions, which would lower the unemployment rate, what I'm trying to think about is what amount of Fed buying could help open schools? What amount of Fed buying could help disincent people from staying home because they're being paid? And the answer is the Fed can't help that. You want to incent people, you have to cut some of the benefits. You want to get people to go to their jobs, you got to open the schools. And I get it that there's barriers there, but it just kind of gives you a microcosm as to the myopic thinking of the Fed and why they have been so horrible in their forecasts, in their projections, and in their actions by painting themselves into a corner, because the Fed, unfortunately, can't see the bigger picture. Now, people like John Williams and many other people in the Fed have never so much as had a lemonade stand or a paper route, so therefore it is difficult for these academics to really understand how the economy works, although these people at the Fed are charged with pricing the most important commodity in the world, and that is the price of money. Now, this week it'll be interesting because we also get numbers on inflation as reported by the CPI report. Now, this is going to be released on Thursday, and that CPI report is going to probably see the core rate of inflation jump from an already pretty hot number of 3% to probably in the 3.5% range, because remember, we're going to replace May of 2020, which was a negative reading, negative 1/10, with more than likely kind of a hot reading, maybe 3, 4, 5, 6/10%. It's going to put the inflation rate year over year at 3.5. And historically speaking, when the rate of inflation is higher than the rate you can offer on mortgages, that situation doesn't last for long. Something's got to give. Either the rate of inflation has to come down or mortgage rates have to go up. So let's watch what happens when we get that number on Thursday. Ahead of that, it will be even more interesting to see how the bond market reacts to the 10-year Treasury note auction. That'll be on Wednesday afternoon. And will the buyers of Treasuries ahead of what looks like it could be a hot inflation number buy with a lot of enthusiasm? Not so sure. I think there'll be a lot of volatility around those two reports. So if you're not already on it, why aren't you on MBS Highway? So you can protect yourself, your family, your customers, your referral sources with understanding the market and so many other tools that allow you to achieve the growth that you deserve. Hope you guys have a great one. Bye-bye.
Be sure to click on the link below for your free 30-day MBS Highway trial.